I'm the Director of Finance and Controller at Keytronic Corp. I've been with the company for almost 11 years now, and I'm joined here in Spokane with our Chief Financial Officer, Brett Larson, and our Director of Finance and Internal Controls, Mark Hilbert. I'll start the presentation by going through a brief overview of the company, and then Mark will follow up with some financials. He'll present that piece. We have Brett Larson, our CFO, on the line as well. He's going to completely add color commentary as we go through it and probably totally get me off my game here. So we'll get started here in just a second. Brett, you want to say anything before we go?
I don't think so. No, I'll keep you honest, Tony.
I appreciate it. Thank you. Okay, so we're going to get started here. Make sure I can change the... there we go. Technical difficulty. Okay, so I want to start things off here by letting you know what the Keytronic mission is. The Keytronic mission is to provide our customers with superior manufacturing and engineering services at the lowest cost for the highest quality, all while creating a long-term mutual beneficial relationship by employing our trust, commitment, results philosophy. So I think it's important to start with a little background information of Keytronic. Keytronic was organized in 1969 as a Washington corporation that manufactured computer keyboards. As a computer keyboard market matured with increasing competition from international providers, we determined that we no longer solely could rely on keyboard sales alone. As a result, in the early 90s, we assessed the market conditions and our internal strengths and manufacturing capabilities and determined that we needed to shift our focus from keyboard manufacturing to contract manufacturing. Contract manufacturing is essentially a form of outsourcing. A contract manufacturer enters into a contract with a firm to build that firm's product on their behalf. Keytronic's unique strategic attributes are based on our core strengths of innovative design and engineering expertise in electronics, mechanical engineering, sheet metal fabrication and stamping, and precision plastics, combined with high-quality, low-cost production and assembly on an international basis while providing exceptional customer service. These strengths have made our company a strong competitor in the electronic manufacturing services market, or EMS. That is also what we refer to as contract manufacturing. The expansion of the EMS industry and our acquisitions have allowed us to continue to expand our customer base and the industries in which we serve. We had a few very important and strategic acquisitions in the last 6 to 8 years. The first of those being the acquisition of Sabre. Sabre was located in Juarez, Mexico, and they were a sheet metal fabrication outfit. We paid $6 million for Sabre through existing cash on hand. A year later, we acquired Ayrshire Electronics. Ayrshire, they provide printed circuit board assembly and other electronic manufacturing services, and we purchased Ayrshire for approximately $48 million, funded through borrowings on our term loan, our revolving line of credit, and cash on hand. When we purchased Ayrshire, we purchased 4 locations, of which 3 are remaining today. In 2016, we closed our Harrodsburg, Kentucky facility to reduce costs and improve our operating efficiencies. During fiscal year 2019, we wrote off $12.5 million of goodwill and other intangible assets as a one-time non-cash charge. So you fast forward just over 50 years, and this is where we are today. During fiscal year 2020, which our fiscal year spans from June 30th to June 30th. So June 30th, 2019 to approximately June 30th, 2020. We recorded approximately $450 million in revenue. We have a global footprint that includes 5 domestic facilities and 4 international facilities, and employ over 5,700 people worldwide. And we service over 200 customers from which we manufacture product. This is a small sampling of some of those 200 customers. As you can see, we build product for some very large companies. Many of the products we produce for these customers, you probably see or use every day. There are certain accounts that fit better with us than other accounts. So we have a certain target accounts that we primarily go after. Those target accounts are generally programs with $5 million to $80 to $100 million in annual revenue per year. That is a big range, but that seems to fit us pretty well with our capabilities. Generally, those accounts involve at least 2 production technologies, meaning they require us to perform some form of plastic molding and electrical assembly, or box build and sheet metal. We prefer that it has those. Additionally, we look for those accounts that have challenging or unusual manufacturing skills required. And that's something that Keytronic is very good at. We have a great group of engineers that really have the attitude that they can figure out how to build anything. So if it's difficult to build, we're the contract manufacturer for those folks. We also look for target accounts that are complex, and like I mentioned just before. We also look for those target customers that have a high value on responsiveness and customer service, and that are really looking to seek a long-term relationship. So EMS providers or contract manufacturers are just generally classified in tiers. The highest level tier is a tier 1, and providers such as Flextronics or J-Bill Circuits reside in that tier, as their annual revenue is in excess of $2 billion or more. Keytronic, at approximately $500 million in annual sales, is in the lower end of tier 2 range, which is $400 million to $2 billion in annual revenue. And then finally, you have your tier 3 suppliers. Generally, those contract manufacturers are generating revenue in the range of $100 million to $400 million. Currently, Keytronic is the 7th largest manufacturer in the United States. And Brett, I might be wrong on that. I think we might be the 5th now. Is that right? He's muted.
Yeah, I think we are now with the recent growth over this last year.
Excellent. Yeah, I apologize. We are. I thought I read that we were the 5th. Thank you, Brett. Moving on to our global value, the global value of Keytronic. One of the key reasons Keytronic has been able to continue to grow over time has a lot to do with our capabilities in engineering services. We are extremely proficient in helping our customers with the design or the redesign of their product and its manufacturability. Another key reason is the breadth of our vertical integration. We have excellent SMT capabilities, which stands for surface mount technology. We have excellent plastic molding, including both injection molding and blow molding. We have a full service sheet metal shop, which includes metal fabrication, metal stamping, automated and manual powder coating capabilities. And we also have full box build or final assembly capabilities. Many contract manufacturers of our size only have one or two of these capabilities. So as a result, our vertical integration adds tremendous value in terms of potential cost savings to our customers. Our supply chain advantages is another key reason companies outsource their production to Keytronic. Due to our size, we have a level of purchasing power that our customers are unable to attain without our involvement. All of these key reasons are what makes our value add. And we refer this value add, we refer to it as sticky, meaning once we get a customer and we redesign their product and they refine their manufacturing of their product, when we get them under our wing, it is very difficult for them to move away from us. So if you've ever heard Greg Gates speak at one of our investor conferences, and you've heard him talk about having sticky relationships with our customers. This slide represents roughly what our current production is worldwide. Currently, Juarez is our largest manufacturing facility, and they represent roughly 70% of our total revenue or manufacturing. Our domestic sites in the US, they represent approximately 27%, and both of our other international sites in Da Nang, Vietnam, and Shanghai, China represent less than 3% of that total revenue at this point. So as we talk about our global locations, our global headquarters is here in Spokane, Washington. The operations that we serve here are engineering, program management, supply chain. We have all of our G&A folks, so it's important people like accountants are here in Spokane. We also have a tool shop just across the way in the industrial park. There they build mold tools and other tool shop type repair activities there. We also have a testing facility in our shop here in the basement of our shop where we test packaging and other drop tests and other things like that. We have 250 employees currently employed in Spokane, of which many of them are currently working remotely. Another one of our U.S. facilities is our El Paso, Texas warehouse. So I'll talk a little bit about this more later, but this is our El Paso facility is very related to our Juarez manufacturing as well. So we established both Juarez and El Paso in 1984. Primarily, our El Paso facility is for distribution and warehousing. We do have a small amount of vendor managed inventory there as well. So Fayetteville, Arkansas is one of our domestic facilities, and this was part of the Ayrshire acquisition that I mentioned previously. Our Fayetteville location provides full service PCBA facility as well as final assembly, warehousing, and distribution. We currently have 5 SMT lines in our Fayetteville location, and we have a significant amount of pin through hole automation as well. Oakdale, Minnesota is another one of our domestic manufacturing locations. Again, we provide full service PCBA as well as final assembly, warehousing, and distribution at that facility. Our Oakdale facility does specialize in medical and defense programs. We again have 5 SMT lines there. Corinth, Mississippi is the final Ayrshire acquisition that we have. They are a manufacturing facility. And again, they do provide full service PCBA, final assembly, warehousing, and distribution. We do have a dedicated line there in Corinth for LED and LED, high-speed LED SMT line. One of our international facilities is located in Shanghai, China. We established that facility in 1998. It currently has 3 SMT lines and approximately 200 employees. It is wholly owned by Keytronic, but is managed by our Chinese locals, and they perform PCBA, full service PCBA, final assembly, warehousing, and distribution from that location as well. Our next international location is in Da Nang, Vietnam. This is our newest manufacturing facility that we established in 2019. We currently only have 1 SMT line in that space. However, we have plenty of space to add 2 additional, which we will do as the capacity requires it. Currently, we still have 60% open capacity in Vietnam. We perform the full service PCBA, final assembly, warehousing, and distribution in that location as well. And it is wholly owned by Keytronic Corp here in Spokane, Washington. Okay, the best for last. So Juarez, Mexico is our largest facility. We perform full service PCBA in addition to final assembly, warehousing, and distribution like we do at our other locations. However, in our Juarez facility, we also have plastic capabilities, both blow molding and injection molding, as well as a full metal shop. We established Juarez, Mexico facility in 1984, along with our El Paso facility. We currently have 9 individual facilities on our campus. It's made up of 9 different buildings, and we have over 1 million square feet of warehousing and manufacturing space. We currently have 12 SMT lines, of which 2 are in a clean room environment, which puts us in a class above others. And we employ in excess of 4,600 employees there in Juarez. We do have another relatively new facility. This is a sales facility located in the Netherlands. We started this just last year. We do a little bit of warehouse and distribution there as well, but it's pretty new. So centralized US-based command and control. This is another advantage to our customers. It's our centralized command and control. This makes it easier for our customers to manage the programs that they have with us. We kind of jokingly refer to this as one throat to choke, meaning our customer can pick up the phone and make one phone call to someone working in their time zone to resolve any problem that occurs domestically or internationally. It's also with centralized command and control, it makes it much easier for us to move programs to a different manufacturing location, either domestic or international if it's necessary. This is also a large advantage to our customers, especially if a program's volume grows to a level that makes it an advantage to both Keytronic to move it, as well as an advantage to our customer, as we would potentially move it to a one of our low-cost sites.
Hey, Tony, maybe, if you don't mind, maybe I'll just jump in real quick.
You bet.
Give you a chance to catch your breath. But I think, one important thing, and probably a differentiator of Keytronic from our others within the industry, is the fact that we have a single location that can control all of the production facilities. Most EMS industries, if you want something built in Mexico, you would be required to coordinate your production directly with that plant manager. What we've done is kind of kind of a funnel whereby you can start here in Keytronic, let us know where you want to build it, and then we do all the legwork of ensuring that your product is built in the space that most is successful or most beneficial for what you're looking for. What we've seen recently is that there is a great amount of OEMs or large manufacturers such as GE, 3M, some of the others that Tony put up on the slide that are very interested in getting out of China for a variety of reasons. Initially, it was because of increasing wages, increasing costs that folks were incurring not only in China but also in transportation of goods back here into North America. So there is definitely a desire to get back to North America. And that was one of the reasons why we strategically went after Ayrshire here in the U.S. is that we could help facilitate some of that onshoring, manufacturing some of that demand. So far, it's worked out really well. And what we found as some synergies from those U.S. sites is that a lot of folks want to begin building a U.S. site that they can easily visit. Their engineers can go and touch, feel, and ensure that we are building to their specifications, and it's a product that they want to go out to market. At the point in time it goes to market and becomes a high volume type situation, then they'll look and say, hey, we're going to need to continue to lower our costs on that so that we can continue to be competitive. So then we are offering them, hey, we can take it from a U.S. site, we can easily put it into Mexico, we can put it in Vietnam, which currently doesn't have the tariffs and duties, or if you'd like, we can put it in Shanghai. So it's really been it's been a great opportunity for us to expand our footprint and really be able to provide each of our customers an opportunity to tell us where they want to build their product, and then we take care of all the other details. Tony?
Okay, great. Thanks. What? So I'll continue on then. Feel free to jump back in, Brett, anytime. I appreciate it. My voice was getting rough. So on the previous slide, I talked a little bit about being able to pick up the phone and call one person in our time zone and solve a problem. Well, these program managers, the program management team, are just those people. They work very closely with individuals from all departments throughout the company. They work with finance to analyze inventory and margins. They also work with the factory to solve any problems they may be having on the line. They also work with engineers as we're designing or redesigning or potentially improving production or things of that nature. And then they work with our purchasing group, our supply chain group for that matter, very regularly as well to identify new potential savings in material as a result of alternate components. A program manager at Keytronic will lead his program from the very beginning of the concept of the program to the end of life. And they are responsible for that program the entire time. Through our program managers, our customers have access to executive level management because every program is reviewed every day by our executive team. So as those reviews take place with the program manager, they then can interact with the customer as it's necessary. Program managers, their bonus compensation is based upon our customers' program success from cradle to grave. So it's to their advantage to have successful programs. So we appreciate having that group for sure. So we are continuously improving primarily two areas that affect our business. It's how we build and how we buy. We improve how we build by employing Lean Six Sigma process manufacturing. Six Sigma is a set of techniques and or tools for process improvement. We utilize Six Sigma techniques throughout all of our manufacturing facilities. A couple of good examples of this was the development of our manufacturing shop floor yield and scrap processes. By improving those processes and adding proper inspections, we were able to improve our yield percent and decrease the amount of scrap, thus making our margins better and making our customers happier. We improve how we buy through our continuous quoting activities and by providing alternate material proposals to our customers. By utilizing our extensive supply base that has been carefully audited by our supplier quality team, we are able to provide our customers with the best components at the lowest cost. Obviously, we're able to gain some material margin by performing these activities for our customers. So this is just a really great example recently of a cost reduction activity of one of our Fortune 500 entertainment customers. We were able to generate 4.5% per year savings in each of the last 6 years. We were able to do this by performing those process and design reviews that drove manufacturing improvements that reduced manufacturing time. We were also able to perform material reviews. These material reviews decreased the overall cost of the product via alternate material or by identifying lower cost material throughout the marketplace. And finally, we were able to improve by insourcing certain subassemblies that were previously purchased components. Our vertical integration is what allowed us to do that. So this is a kind of just an overall brief summary of what it is, what we do, and how we do it. I think that's it for me at this point. Mark, do you want to start with some financials?
Mark, I'm not sure if you're trying to talk, but I don't think anyone can hear you.
Are you there, Phil?
Yes. All right.
Apologize for that. I thought I was unmuted on my phone here. Let's start this. Let's start this again. So, a couple things prior to jumping into the financials I wanted to point out is the Securities and Exchange Commission's EDGAR site, their search site. A lot of you are probably familiar with this, but if not, it's a great resource to find any SEC filings that a public company has submitted. 10Qs, Ks, 11Ks, 8Ks, anything that they filed, input their ticker symbol into the quick search and it'll pull up a comprehensive list. You can do that for KTC or Keytronic. Our ticker symbol is KTCC. We are traded on the NASDAQ, and our current market cap is about $82 million as of yesterday or today. The last thing I wanted to point out is our website, keytronic.com, and then if you /investor relations, you can get all the company information. You get another link to our SEC filings. You'll just be able to see our press releases. A lot of times, if it's not material to the stakeholder, we will issue a press release as opposed to an 8K. A press release will be accompanied with an 8K if it is material to the stakeholder. So you can find these press releases on our website that wouldn't necessarily be in our SEC filings. Same thing with latest news and then our investor relations contact information. If you have any questions or want an investor relations packet or anything like that, that's the place to do it. So moving into the financials, here's just a basic income statement for Keytronic. This compares the 3 months ended Q4 year over year. So essentially this is June 27th, 2020 compared to June 29th, 2019, end of both of our fiscal year 2020 and 2019 respectively. A couple things I just wanted to point out with this is the top line revenue growth. And just as a disclaimer here, when I'm going through a lot of these financial statements, this is relevant because it's in the COVID environment that caused a lot of companies to scramble, some to fail, some to thrive, some to be just that right in between. For Keytronic and very, very high level, it was a net positive for our company, strictly based on the programs and the size of the programs that we currently have that are in industries such as healthcare or medical or home exercise equipment. Things like that really skyrocketed and demand increased substantially for those. On the flip side, we have customers such as IGT that Tony talked about a little bit earlier on the slides that are in the gaming industry. We build slot machines for them. Obviously, with casinos shut down and things like that, that demand dried up rather quickly. So it's not all positive, but definitely not all negative. We actually ended up growing during the COVID environment. So those are the kind of things I'm going to be pointing out going through these statements of income. For example, quarter over quarter, so Q4 FY20 versus Q4 FY19, there's about $10 million revenue growth. And that's due to just what I explained, successful ramp of new customers as well as increased demand of existing customers. Another important note is to look at gross margin year over year for these 3 months ended. You'll see gross margin and in turn, net income is actually lagging. Both of these were constrained by additional COVID-related expenses. For example, in our Q4, we had about $2.7 million or 19 cents per share of additional COVID expenses. And just as a refresh, our fiscal year, our third and fourth quarter is January through June. So that's kind of right in the COVID timeframe. Our fourth quarter obviously being the end of June. So as you can see, there's top line revenue growth, which is great, but lagging gross margin and net income due to the additional COVID expenses. We do anticipate those COVID expenses to be far less as we move forward. So the top line revenue growth is great news. Moving into 3 months comparison, just sequential. So our Q3 versus our Q4. Here, just in one quarter, there's about a $4.5 million revenue growth, and it's for the same reason, as a result of the same reason of these new customers and increased demand from existing customers during the COVID environment. So here's the slide here showing about $4.5 million of increase in revenue. You will see the bottom line EPS grow with that as our initial COVID expenses have already been, our initial COVID precautions have already been implemented. We should see the EPS and gross margin, net income, and EPS catch up with our top line revenue growth. So the next one is just a year-to-date, so a 12-month comparison between our fiscal year 2020 and our fiscal year 2019. Top line, overall revenue decreased year over year. This is primarily due to Q1 of our fiscal 20 and Q2 of our fiscal 20. We had significant capacity constraints, as well as workload balancing challenges, and other things like that in our Juarez facilities. This led to an increased factory spending in Juarez, mainly in our metal fabrication departments. So essentially what happened is we experienced an unanticipated increase in sheet metal demand, leading to significant capacity constraints. So our investments in our sheet metal departments and other fabrication departments help solve those constraints and get us past it to get that revenue in Q3 and Q4. Another thing of note here in FY19 is this impairment of goodwills and intangibles line. Tony briefly mentioned it earlier, but essentially what that is we had goodwill and intangibles related to our Sabre and Ayrshire acquisitions. And what was book value of those when we wrote it off was about $12.5 million. So what happened was customer push outs, this is in 2019, customer push outs, there were some part shortages, there was delays in certain larger programs, and at that point we had a depressed stock price. So couple those together leads to what's called a triggering event for an impairment analysis. So we had to do a full qualitative and quantitative impairment analysis, which led to the eventual impairment of goodwill and intangibles. Again, though, this is a one-time write-off. It was non-cash, but essentially it's just writing off any goodwill that was related to our acquisitions back in 13 and 14, I believe. Moving into kind of more of a gross margin analysis, you'll kind of see over the last 2 fiscal years, this goes from Q1 19 to Q4 FY20. And we kind of hang out within the 7 to 8% gross margin range with a goal of above 9% gross margin. You'll see in Q4 of FY20, we did achieve the 9.7% gross margin, which is well inside that goal. However, that excludes the $2.7 million of additional COVID expenses. So these additional COVID expenses directly relate to our temporary shutdown of our Juarez facilities during the COVID initial scare, the restart of those facilities, and a lot of these preventative measures and preventative equipment for employees in all of our facilities. These include things, of course, like masks, gloves, things like that, but it also includes temperature kiosks, employee check-in stations, plexiglass between workstations in the factory, things like that. So,
hey, Mark, sorry to interrupt. This is just a great time to kind of answer Nathan's question. He had a question on the chat there, and he was basically asking that why we had a $1.4 million increase in compensation at our Juarez facility to reduce turnover of available employees and preventative measures and equipment for employees in the U.S., China, Mexico, and Vietnam. And his question goes on to state, is the Juarez facility having turnover issues? Question. Is this management leadership issue? Question. And are the other locations facing turnover issues? So that's a really good question, Nathan. And as we look at this, that $1.4 million that you're speaking to isn't at all related to management or leadership issues. It's specifically related to our COVID-19 additional expenses that we're having to pay those employees in order to get them to come to work due to the COVID environment. In some cases, because labor is tight in the Juarez area, we have to make it more favorable than the other maquiladoras. So I don't think we talked much about what a maquiladora is, or we probably haven't at all. But a maquiladora is essentially a U.S. company that manufactures in Mexico. So in order to get those employees that we need to build our product, we had to incentivize them to either come to work because they were scared of COVID, or we had to steal them from another maquiladora by offering a package that was more beneficial than the place they were working. So that is kind of what was going on there as a result of those compensation increases in Juarez. So to answer your turnover question, it isn't really a turnover question. It's more of related specifically to just COVID. And then you asked, are the other locations facing these turnover issues as well? And no, they're not. Surprisingly, our Da Nang and Shanghai locations, other international locations, are not having any issues with COVID related or temporary workforces, leaving us. And we have plenty of staff in our U.S. locations right now as well. So great question. I appreciate it. Mark, I'll let you kind of get back to it here.
Sounds good, and thanks, Tony. If there are more questions in the chat, I don't see a chat function in as I'm presenting. So
they do have some there. They have a couple more. We could go through those right now too, if you want, Mark, or do you want to wait till the end?
I have no preference. That's totally fine. I can't see the questions, so if you wouldn't mind reading them, that would be
okay. Sure, I can do that. It says from Brock Briggs, he has a couple of questions. Question about contracts. So he asks, what is the average contract length and what % of customers on average return for another contract after their first? And then his third question is, are you able to give any details on size or duration of the contract with FRR? I'm not sure what FRR stands for COVID mobile testing devices. If you want to, hey, Brock, if you want to let me know what FRR stands for, I'm not familiar with that acronym.
Yeah, it's FIONet. I got that one. Yep.
Oh, great.
So what that is, yeah, absolutely. Average contract length, we typically sign up most of our contracts for 3 years. Many of them go well beyond 3 years. In fact, A few of them are going over 20 years of doing business with us. But I'd say on average, age of our customer base right now is somewhere around 3 years because we have so many that are fairly new, as we've been able to add on quite a few over the last 3 years. I'd say probably 80% of our customers on average return for another contract or another program. If a particular device or particular product that we're building, probably 80% come back and say, hey, you did such a great job on that. We'd like you to build this. Or, hey, we've got a second gen that we want you to take a look at. This one will eventually age out. I'd say probably 80% typically do. And then as far as the size and duration of the FioNet, that's an interesting one. That was initially a device that was for blood testing in the fields of rural locations, third world countries that medical professionals could go out in the field and actually test for various diseases. What they found is this also can easily be adapted to also do rapid testing for COVID. They're still developing that. I don't know the size. I don't know the actual production quantities that we will be building, but I do know that out there it has been disclosed that Keytronic has been awarded this. We actually have done some production early on with FioNet previously, at this point, not extremely material, but hoping for them and for us that we can get a great device out there that can be used in very remote and difficult locations.
Hey, Brett, if you don't mind, I'd like to add to question number 2 there.
You bet.
To what % of customers on average return for another contract? And that's a great question too, Brock. So previously in my kind of prepared remarks earlier, I had a slide where we talked about programs being sticky. And Craig Gates, he's our CEO, he really loves to use that acronym because when we talk about having a sticky program, it's really related to our ability as a contract manufacturer to really refine the design. Either we design it for our customer or we redesign the product for our customer, and then we put it into our factory and start manufacturing it. Through that manufacturing process, we're really able to improve how it's manufactured, and we're able to manufacture it essentially better than the OEM or the company that we're building that for. So yeah, that's a great question. And I'm going to again use that term sticky because we do get those renewals and contracts. And we have some customers where we've been building for them for, what's the longest customer? Is it 15 years?
Actually, no, I think we've got a few that were back in 1998.
Oh, see, there you go. So great question, Brock. Thank you.
All right. I did find the chat function, so I will be on nose a little bit. So we're good there. Kind of something I wanted to point out as well. Here, it looks like in Q3 of FY19 on this slide here, gross margin dipped about 6.3%. This is kind of the opposite cause of Nathan's question earlier. It has to do with turnover, yes, but this has to do with us having to pay severance of, there's about a little over $1 million in severance during that quarter as a result of a reduction in force in our Juarez facilities based on an overall reduction in orders of 2 rather large customers of ours. So we are required to pay the severance expense as we reduce the workforce in Juarez. It just so happens now that we have a shortage of labor in Juarez, so we are actually paying a premium to keep these people in our facilities and keep up with our large increases in demand. So that was the dip there of about 6.3% gross margin, and as you can see, it's climbing up as our top line grows. Contract manufacturing in nature has high fixed costs, so we are rather volume based. So when we can grow that top line with good business, with good margin business, it is rather quickly reflected in the bottom line. Going down to one of the bigger balance sheet line items here, this graph really shows, it indicates our inventory levels, and it really shows our growth over the past about 5 fiscal years, especially that large increase between Q1 FY19 through our most recent fiscal year end of 20. This is attributable to really 2 main reasons. One is obviously growth. As we grow, obviously our inventory levels are going to grow. You know, in contract manufacturing, the ramping stage of programs takes time, often over a year to even 18 months. During this time, when we're ramping a program or a new customer, we're bringing in inventory to build this newly won product, but we haven't yet started production. But another key factor that played into our inventory levels increasing as they have is part shortages. Now, these part shortages, I want to kind of play an analogy of a golden screw analogy here that we talk about within the company here. So with part shortages and other types of allocation, we will build a unit, and 90% of materials and parts for that unit is readily available, or at least within normal lead times. But that remaining 10% or 5% or sometimes even 1%, or what you call the golden screw to put the whole product together, is on allocation, or it is some shortage of some kind. So we end up bringing in 90+% of the material, and we have to sit and wait to commence production until that last 10 or less than 10% of that material comes in. So that adds to a ballooning effect on inventory. So those are the 2 main driving factors of our inventory and how they balloon like that. Because of this, because we know that this happens and we have contracts with our customers about that have specific inventory clauses in them that states, for example, we will buy this inventory on your behalf. You give us a forecast and we can purchase this raw material to your forecast. If you miss the forecast, you as in the customer is responsible for that inventory. So we don't have to take unnecessary risks with that. So we have those same clauses as we start building their product, especially with product that takes a little bit longer to build. They can't just place an order, a week into it, we're halfway finished with it, and then they cancel the order. So all those clauses are within their contracts and things like that. So there's inventory. I'm going to move to some key balance sheet ratios. And then on Quinn's question, we can wait until the end on that one. We can give you pretty good insight on that. Just a couple more slides and we'll address that. Some of the key balance sheet ratios here. I mean, you have a solvency indicator and your current ratio. Ours, which hover around about 2 to 2.5 times. And then we also have a leverage indicator here, debt to equity ratio there, hovering around 0.4 to 0.6 over the last couple fiscal years, really starting with the acquisition of Ayrshire is that large spike. Just a couple balance sheet ratios for you. Then I wanted to give you a brief, our Q1 did just end and we just filed our 10Q for it. I wanted to bring in an income statement for the end of Q1. This is 3 months ended here, to show the continuation of this top line growth. As we've said a few times on our earnings release, on our investor calls, that our growth is projected out through this next fiscal year to grow the top line pretty significantly. Just to demonstrate that, from Q1 quarter over quarter, it's about an $18 million in revenue growth on the top line. Again, those EPS and, well, starting with gross margin all the way through EPS, those are lagging due to those COVID expenses. We hope that that will subside here in the near future. There is a lot of uncertainty with that, however. Then going into just another comparison of sequentially. So this is Q4 versus our current fiscal year Q1. There's another increase in top line revenue. Q2 guidance, you can find this in our most recently issued earnings release. We guide out about a quarter in time. So for Q2, we are projecting revenue to be in the $125 to $135 million range. The COVID is constraining this number. We have demand that far exceeds that. However, we need to take into account OR's facility labor constraints and as well as other shortages. Following that, guidance on EPS here is about 15 to 25 cents tax affected. So these earnings again are constrained by the macroeconomic uncertainty and what those additional COVID expenses in the quarter could be. So kind of some takeaways here on our FY20 and beyond. Some of the pros and benefits here. So increased overall customer demand, absolutely. That impacted the second half of fiscal year 20 significantly, and that will impact FY21 and beyond after that. See a question coming in. So on your balance sheet, how did your total assets increase by $70K from 2019 to 2020 when your liabilities increased 30 and CapEx was 8.6? Doesn't add up. Did certain assets appreciate significantly? Where did this come from? So on Trevor, are you looking at the balance sheet for the current fiscal year end? That one, I'll pull that
yeah,
one.
I am.
I'll pull that one up.
I use the SEC filing.
Sorry, go ahead.
Yeah, I use the SEC filing for fiscal year end.
Okay. And specifically, you're talking, let's see.
Well, it says total assets was 238,000, and then it increased to 304,000 in 2020. But there was a like capital expenditures was like 8,600, and your liabilities only increased about 40,000.
Sure. So with that, would you mind, sorry, muting me? So there's a leasing standard that was introduced, ASC 842. So essentially what this did is take all off-balance sheet financing in the form of operating leases and require companies to put them on the balance sheet. So we had to present value all our operating leases, and they are now called financing leases. So, and they are essentially capital leases. So they're on the balance sheet here in this operating lease right of use asset. So essentially you'll see an increase of about $17.5–18 million from prior year end, because those were previously not on the balance sheet. That's probably the majority of your increase that you're looking at. Other than that, obviously trade receivables went up significantly. What else happened here? Here's your corresponding operating lease liability. So that's probably the majority of what you're seeing on that increase. Does that answer your question?
Yeah, if you look at the long-term liabilities, actual long-term liabilities went up by roughly $47 million, which includes the operating liability, and we were forced as well to take on quite a bit of debt to pay for that extra inventory that we took on.
Yep, and then to Brett's point there, there is a large increase there, but there's about $15 million of that has to do with factored receivables. So essentially, I don't know how familiar you guys are with factored receivables, but essentially we have a true sale agreement with the bank. So we sell receivables to get paid right up front. The bank then takes on that receivable and collection duties from the customer. So in prior year end, is that $23 million here, you won't see that we sold about $15 million of factored receivables in there. But now that we don't have that agreement anymore, since we changed our credit facility, those factored receivables will be reflected in our revolver balance. So that's part of the other difference there. Okay, perfect. So back to the pros and cons and of this year and beyond. Our goal and what we've seen as a lot of our benefits is the increase in customer demand as well as new programs. So that's going to impact us from fiscal 2020 and on. Operating expense reduction is always a key indicator that will transfer to the bottom line. That's the same thing as we invest into our SMT or mainly CapEx in general, invest into our facilities. We should keep driving operating expense reductions that will impact fiscal 20 and beyond. Material cost decreases, Tony touched on that earlier. That's the same thing. Those are impacted the current year and beyond there. So this resilience during pandemic, that's another one that we're very fortunate to have the broad customer base, how we cover so many industries that we do. It allowed us to mitigate a lot of that risk and really diversify. So that was really noticed in last fiscal year, and it's already being noticed in our current fiscal year of FY21. That is another thing that, if God forbid anything happens like this again in the future, we'd look to that as well to pull us through, and not just pull us through, but to grow during it and take advantage of the situation. Constraints again, we talked about this a little bit, but yes, we initially our Juarez facilities were closed for approximately 10 days. That had a huge impact, and we were fortunate to only have it shut down for 10 days, and the executive team had put in a lot of work to make sure that closure time was limited. So hopefully that only impacts FY20, but there's always that possibility. COVID expenses, labor constraints, those go kind of hand in hand with this pandemic environment. And then part shortages, those seem to be easing over the last couple of years. Everything, if you think about nowadays, everything kind of has a circuit board in it, from your cell phone to a toaster to everything in your car. So these parts were in high demand and very low available quantities. So hopefully we've caught up with that. The market's caught up with that, and those don't impact us too terribly much in the future, but there's always a possibility. And then, of course, cash conversion for any company is always of paramount importance. If we get a large customer, they have, the bargaining power. They require 90 to 120-day terms, but we have 30-day terms with our suppliers that we're getting components for that customer. That can be an issue. So that's always in the forefront of our minds, and hopefully, we can improve our cash conversion cycles, as we go on. Most of this stuff is what Tony talked about earlier, so I'm not gonna touch on much of this, but that's kind of some key takeaways for Keytronic and how we operate as a whole, and that's all I had. So if we want to, I know there's a couple questions I need to go back to.
Are you going to address the administration question?
Yep.
Yeah, I can do that one. I'd be happy to do that one. So this is Brett. So, we've looked at this and we'll continue to look at it. Both some pros and cons with the new presidential administration. Some of the things that may or may not change depending on which side of where the Senate lands. But some of the things that have been a benefit for Keytronic have been, of course, the tax savings, corporate tax savings. Definitely has put us in a position whereby our domestic sites are far more competitive at a 21% margin, a taxable margin, rather than what they were previously. There's discussions of possibly getting rid of those in the future. That might have a detriment on some of our U.S. locations. Tariffs, that'll probably be a big thing. We know that the trade wars between us and China have definitely flared over the last 18 months. That has been both positive and negative. Positive in the fact that we've seen a big increase in customers wanting their product built in North America, particularly under the new USMCA agreement, the replacement of NAFTA, whereby we can import parts from China into Mexico and build a Mexican-based product and then import it into the U.S. Tariff and duty-free. Will the new administration continue that trade war? Not sure. That we're definitely all eyes on that, as well as immigration. We use quite a few international employees, particularly from Mexico, that we'll bring up from our manufacturing site to help in the engineering and design product development here in Spokane. Recently, it's been very difficult, not only with COVID, but also some of the immigration law changes of getting them into the States to be able to work with us. That might, with the new administration, might free up and allow us to bring a few more of our folks to come up and work in Spokane, help us be successful. We'll wait and see. We don't see any really big changes other than probably the taxes and the tariffs at this point.
So, Brett, that kind of addressed Nathan's question a little bit as well. A follow-up on that is saying, do you see the company moving the KTS location if tensions drastically increase? Do you want to talk about KTV?
Yeah, you bet. So, we had looked at Vietnam probably 4 or 5 years ago. We always knew that we needed another footprint in Asia. We had looked at a variety of different countries, but really kind of made that last decision was the ramping trade tension between the U.S. and China. So we needed another low-cost site in Asia. We were fortunate to find a brand new facility in Da Nang, which is in central Vietnam. Beautiful place. I just wish the plane flight wasn't so long. That kind of gives us a China alternative in Asia. And at the point we started up that facility, we were very concerned that, hey, would there be enough volume to justify keeping Shanghai facility up and operable? So we took a couple of steps. One is we really ramped up our sales force that was China-centric. We actually added on staff a brand new business development person that had a deep book of customers there in China. So we're actually now looking at building parts product for China consumption rather than importing back into the U.S. Additionally, you saw, I think Tony mentioned our sales office out of the Netherlands. Previously, we haven't had a big footprint, or we really haven't done a whole lot in the EU. Netherlands kind of gives us an opportunity whereby we have a sales office that can also market the Shanghai production into Europe. Of course, the tariffs and the duties that you have importing Chinese product in the U.S. does not exist over in the European Union. So those two things have been successful, and it really looks like we're going to continue to have two Asian production facilities. China's really done well and continues to make money, and Vietnam is up and coming. So we have no current thoughts of closing it down.
It looks like Trevor had one on any plans to acquire any more manufacturing companies for expansion in the next 5 years. Do you want to address that?
Absolutely. The acquisition of Ayrshire was very beneficial. But we're also a fairly conservative group, and we feel fairly leveraged right now. So I think what we'll need to do is to bring down working capital a bit. We're anxiously trying to bring down inventory levels. Mark, I think you spoke to that. At the point in time that we're able to pay some debt down, we will definitely be back strategically looking at future acquisitions that help us grow.
Yeah, and we've been looking the past couple of years. There's been certain opportunities that we've looked into. None of them coming to fruition, but we're always looking at. And I've had the opportunity to do the due diligence on any potential acquisition, and it's a constantly looking. And if it's the right fit, I would assume after with you're not as leveraged that we would. Do you foresee needing to take on any more debt, or will the revolver cover any near to midterm shortages?
I can take that one too. We moved to Bank of America in August, which was an asset-based loan that actually grows with us. So it's really a $98 million total loan package that really has an additional $25 million expansion that they've also said that they're willing to offer to Keytronic at the point in time we need some more dollars. So at this point, I don't expect us to take on any large additional debt. We may here or there bring on, a $5 to $10 million loan to help pay for capital expenditures in the future. But we're expecting this Bank of America revolver to help pay for working capital for at least the short to midterm.
All right, well, I'll take my opportunity to vamp a little while we're waiting for any more potential questions. As we see low or no or even negative interest rates, does that change your emphasis on the cash conversion cycle, since the cost of financing cash versus holding cash may actually invert?
Yeah, no, absolutely. The back in the day where we were paying much higher interest rates, we were less likely to give a customer, 60, 90 days to pay for their product, whereas that's pretty standard now. So definitely, EMS industry has been forced in this low interest rate environment to continue to offer term changes. And, we'll probably carry a little more inventory than we would otherwise, just because the debt is fairly cheap to pay for. And because it is so inexpensive at this point in time and into the foreseeable future, you really don't look at much in equity raising either. Whereby I think our investors are requiring some 14-15% return. And that could be 3 or 4%. So that's also put a kibosh on really any real plans to do any type of equity raising at this point.
And it looks like Trevor had a question. According to your SEC filing on June 27, 2020, there were 645 shareholders of common stock. What percentage of your stock do your largest shareholders hold?
Yeah, I think we've got a couple that are right around 10%, knowing that no single investor owns more than that. We're a micro cap, and we're fortunate that we have a number of institutional investors that have held Keytronic for a number of years. But yeah, I think we've got 2 or 3 that are around 8 to 10%.
Yep, that's correct.
All right, and then a little more broadly, what companies do you compete with most?
Boy.
And then add on, does this relate to the tiers you mentioned and kind of what the breakpoints of those are? Is it capability based? Is it scaling based?
Yeah, that's kind of a loaded question, because in any type of quote opportunity, we could be competing against a small mom and pop contract manufacturer that does, $20 to $40 million a year, where we could be competing against like a Flextronics that is in excess of, $10 billion. Predominantly, we are typically competing against larger EMS competitors. We're unique in the fact that we offer such a broad manufacturing capability. So we can do plastics, SMT, printed circuit boards, design, metals, plastics. All of those things at our size is pretty atypical. So the types of programs that we're quoting, we're typically quoting against larger competitors. And one of the reasons I think that we're able to win against the backdrop of much larger competitors like Flextronics, Celestica, even a Benchmark, Kimball, all of those is the fact that they're going to get A-class service from us at $20 to $50 million program. If you take a $50 million program to a $10 billion company, you're not much more than just a pimple. It's nothing that you're going to get the attention of the execs or even management at that level. Whereby if we get a $50 million program, well, that's 10% of our revenue. Of course, you're going to get the best service ever, and you'll get direct relationships with the entire management team. And we've been very successful with that, particularly in our command and control strategy.
And then we can do Lane's question. What does the timing of cash flow from a new program typically look like? I'm guessing this is either a new contract or a new line.
Yeah. So typically, in a new program, so we're finding that at the time that we are awarded a program, it's usually 6 to 9 months before we are even able to build the first product. So it's a fairly lengthy cycle from win to initial production. And then probably the first quarter after that, you're investing far more cash than you're generating because, of course, your inventories lag by, some 60 to 90 days. So you're growing inventory with the anticipation of future revenue. And then, like I mentioned, then you have 60 to 90 days to collect. So you're really not generating cash for at least a year after timing of an award. So that's also one of the reasons why we have so much debt is that at the time that we're growing, we're investing in future cash flows that could be, a year out.
All right. I wanted to follow up real quick on something you mentioned earlier about future acquisitions. You noted that you did take a goodwill write-down from the Ayrshire acquisition, but that you feel like you gained value and will plan to do future acquisitions. Can you let us know some of the lessons you learned from that acquisition and what generated that write-down?
Yeah. So, it was more an accounting requirement because our stock price, because of course the stock price didn't justify having the goodwill on the books. But I will tell you that the Ayrshire acquisition actually fared as good or better than what we anticipated. So that $48 million investment into Ayrshire has definitely transpired into incremental profit to the company. I think in the future, I think we'll take a deeper look at what is the true valuation of the assets at the time of the acquisition. We may have undervalued some of the intangibles. We may have undervalued maybe some of the equipment and customer relationships, which then, of course, falls into a bucket. Once you value all those things, if there's anything remaining, you just drop it into goodwill. I think in the future, we'll probably take a deeper dive into what are those assets truly valued for and maybe reduce the amount of goodwill that we put on the balance sheet in this next acquisition that we go after.
All right, we'll put out the final call for questions, but barring any coming in, I'd like to thank everyone from Keytronic, Mark, Tony, and Brett for presenting today. I've certainly found it very informative. I hope the teams gleaned some nuggets like I did, especially some nuggets around the benefits and constraints are great for valuing your company going forward. Very rare to get an outlook much further than a quarter out. So especially in this environment. So thank you for that foresight, which will certainly help the teams out. And thank you for your time today. Oh, and like Trevor snuck one in at the right at the end. Who is your biggest client, if you're allowed to disclose?
We really don't. We sign non-disclosure agreements whereby we really can't disclose our largest customers per se. But I can tell you that it is a very well-established consumer product business that is publicly held, and we've been doing business for them for over 15 years. That's a great question. I wish I could.
Disclose what proportion of your revenue that would make up?
It's probably about 25%.
Yep, that's right, 25.
And that's 25% over probably a dozen different products. So it's not 25% of one specific product. We do medical devices and consumer products, kitchenware, to all sorts of things for this large company.
All right. Excellent. Thank you. Thanks again for your time. I'd like to thank all the participants, the faculty advisors, the industry mentors for joining as well today. There will be a recording of this available if you want to go back and really parse out any of the details. Additionally, reminder that questions will be due to me by November 19th. I'll send out an email reminder as well that'll include the link to the recording after this and the key dates going forward. So thanks again, everyone. Have a good evening and good luck in the research challenge.
Thank you.
Thanks, guys.